Afternoon, depending on what side of the country you're joining us from. Charlie McQueen, President of McQueen Financial, thank you for joining us today. Got an incredible group here today to talk about CECL. It's hard to believe we're heading in on 1 year of full implementation of CECL for pretty much everyone here. I know we had a couple late starts based off of your year end, but really exciting stuff here. As we go to the next slide, I'm thrilled. I do have a leader of our interest rate risk and asset liability management business with us, Heather Shepperly. Heather runs one of our three areas of our business model. Our investment advisory group, we saw them recently on some investment presentations. And then our valuation team is actually coming up. We have a presentation coming up here at the end of the year where our valuation team is going to talk about trends in transactions and mergers. So really excited, Heather, for you being here as a leader of one of our three business models and overseeing ALM and CECL. Thank you, Heather, for joining us.
Thank you for having me, and thank you everybody for joining us today. Definitely ready for CECL being live, so it's fun to talk about next steps.
Yeah, it is neat. Live and crazy and learning a lot as we go along the way and helping others learn. So it's really nice. Joining Heather is going to be Troy. Troy, we're extremely happy to have you here. Troy is one of our advisors out of Iowa, and Troy's been very instrumental with the kickoff of CECL, working with everyone and helping close by with Heather in the entire CECL process. Troy, thank you for joining us today also.
Bet I appreciate it, Charlie. I enjoy talking about CECL, so let's have some fun.
Yeah, absolutely. All right. Well, guys, this is one of our typical webinars here today, meeting the structure. If you have any questions, please move your mouse around your screen, hover. You'll find the Q&A button. Click on the Q&A button. At the end of the webinar, Heather and Troy will be going through the questions and answering them, so please put them in along the way, and they'll get them organized as the webinar goes on and address them at that point. Also, this webinar, as with all of our other webinars, is being recorded. Please reach out to your advisor, and they'll be able to get you a copy of it, or go to our website. Our website does have all of our webinars there also, so you're able to see it, watch it, and share it. So again, thank everyone for joining us today. CECL is a really important topic. This is something that is a forward-looking activity. As we get into CECL today, I'm really excited to hear some of the comments by Heather and Troy. As we go into maybe a different economic environment, we're going to see CECL numbers start to change, and so it's going to be a bit of a neat process, I believe. So with that, I'm going to hand it off to Heather, who's going to kick off the informative part of the webinar.
Thank you, Charlie. So what we're going to do today is we're going to kind of walk through the steps now that CECL is live and we're seeing some of the activity that's changing what those reserves may look like over time. We're going to start with our transition entries, making sure that we are entering these things incorrectly in regards to our net worth or capital position, the monthly steps that CECL does entail, some of the market factors that are actually impacting what those reserves are going to look like over time. There's a lot of volatility in the market, as we all know. So we're going to talk a little bit today about what's causing maybe some of those swings and changes over time. There's a lot of mergers and transaction activity. This is a big piece of how we account for some of these reserves going forward as those activities are occurring. And we're going to talk some industry experiences, some of the obstacles that we're dealing with and how we're dealing with that, how we're implementing that, and how we're working around those obstacles. And then, as Charlie had mentioned, at the end, we're going to go through all of your questions. So please feel free to populate those throughout the webinar. So one of the first items that we look at is the actual transition entry that we're doing through the call report. So whether you're a bank or a credit union, this timing may look slightly different for you, and also based off of your fiscal year, that may vary as well. So one of the first steps here is looking at from a banking side. I know the entry of CECL was a little bit earlier than we may have seen in the credit union space. So depending if you're in year 1 or year 2 of this transaction, this is kind of where we stand. As we get into year 3, that adjustment to our capital position will only be 25%, leaving 75% still sitting in that transitional amount, and then to 50% in year 4, and then year 5 at 25. This is that slow adjustment or impact to our capital position based off of that assumed larger reserve that we have to set aside now that we're going to the entire life of the loan, not just a year or 2 of reserves. So as for a bank, we're either in that year one or year two, and then we're going to start to actually absorb some of that adjustment to our capital position. And for credit unions, this past quarter, as of September 30th, was actually our last opportunity to implement CECL. So now we are officially live across the board for everyone. And those that chose to start this as the first of the calendar year, meaning January 1st of 2023. That means that as we get to our December 31st call reports, this will be the first adjustment to that net worth position from a credit union perspective. So just be prepared. If you do fall on that schedule, know that as we get to year end here, this is going to be that first 1/3 adjustment that we're going to start to absorb into that balance sheet. So this is going to be those next steps as we slowly make that adjustment. For some of us, we didn't have to do any adjustment. It was very close to our allowance for loan and lease loss. So this may not apply to you, but just the next step for many, as we saw most actually implemented this as of the first of the year. So just be prepared to start to absorb some of those adjustments. So as we get into our monthly steps, we're going to dive into a few of these items that we may want to focus a little bit more as we go from month to month as we review these CECL reserves. The first is our data entry. We have a lot of activity going on, and we want to make sure we're capturing everything. And we're going to talk a little bit about what that could look like. Our losses, that from McQueen's perspective, we do recalculate these losses on a quarterly basis. Our individually evaluated loan entries, current condition adjustments, and then finally, how we're actually implementing these entries from an accounting standpoint. So what we're going to do today is walk through each of these steps to ensure that everybody is aware of all of the pieces that we need to capture and incorporate into this calculation. So one of the first things is ensuring our proper data entry. So one of the most important parts here is making sure we've captured everything. And when I say that, I'm referring to not just what's on our core, but any of our third-party pools. This was a heavy activity over the last couple of years as lending was a bit difficult to come by. So we see many balance sheets utilizing participation pools. We're seeing a combination of mortgages and commercial and participations, lots of indirect autos, things of that sort. So we want to make sure that we're capturing all of those moving parts in regards to that reserve. So ensuring that we've captured every moving piece, even including some of those credit card balances as well. Now, with that being said, we know that we have some timing issues in regards to relying on those third parties for providing the monthly amounts or the monthly activity that is happening. So there is a little bit of a timing application here that we have to decide on which is best for us. For some balance sheets, we find that we want to wait until we have a final financial. Well, if you choose to do that, that is fine, but we need to be prepared that we're always going to be on a month delay for those entries. Otherwise, our preference here is to actually provide preliminary financials, identify what that reserve is, and then that way we can close our books, incorporating any of those changes on a monthly basis. So this is kind of the two approaches that we have seen across the board, whether that you're doing that month lag or that you're staying on the actual monthly approach, whichever you decide. Just want to be able to stick and be consistent with that going forward. But that is definitely an aspect that we have to make a determination on what is best for us. And that's going to be based off of the activity and the relationships that we have internally and externally. So, Troy, I know as we get into CECL, losses is probably one of the most important pieces in regards to activity that's happened and having that determination. Why don't you tell us a little bit about exactly the approach and the thought process and the importance of what we need to be able to calculate those?
Absolutely. Thank you, Heather. So very, very important. The base of all CECL math is your historical average losses. So it is very important that every quarter you provide us that quarter's charge-offs as well as recoveries. And I want to hit this point very closely because there's a few financials that kind of don't give us the recovery information as consistently, but that's very important that you give us both the charge-offs and recoveries. Otherwise, your CECL number will be overstated, albeit potentially slightly. But yeah, so back to the loss data. So every quarter when you give us the loss data, we will incorporate that quarter's net charge-offs into your historical averages, thus slightly changing your historical loss ratios in the different categories. So very important that you get us that loss data so we can update your historical losses, which will affect your CECL number. Usually not a lot, just based on one quarter, but if you have an extremely high quarter of charge-offs or an extremely low, you may see a somewhat significant CECL impact. Anything else on this slide, Heather? If not, we can move on to the next one. All right, here's another very important concept when it comes to CECL. And it's one that not everybody utilizes, but I would fully recommend it. So I'll kind of explain this a little bit for those of you who are not using it. It's individually evaluated loans. And that is exactly what the title says. It's an individual evaluation of a loan or a loan pool or a group of loans or whatever it might be. For some reason, you want to individually evaluate these particular items as opposed to just letting the model set your CECL number based on your loss history. So let me give you some examples of that. The main example is this first one here, troubled debt. So what, and this is kind of how, very similar to what you guys used to do in your allowance calculation, at least for me personally. I'm a former CFO and I would have a lot of individual evaluated items as part of my allowance calculation. The CECL regulation also allows for that. And it's a very helpful tool because let's do an example. Let's say you have a $50,000 car loan. You have there's a 60% chance it's going to go bad. You would individually evaluate that whole 50,000, and we'll show you where when we get to the navigator at some point. And you would reserve, this is the important part, you would reserve 60% of that number for 30,000. That is a way to basically bump up your CECL number at the time you realize this item is becoming troubled. It will increase your CECL number for that month, and you may have a little additional expense, but it's very important to do that because if you think about the math behind it, you may have 1 to 4% losses in a lot of your categories. But this is a 60% loss item. This is really a way to boost your CECL number appropriately based on different troubled debts. A couple other lesser used items in the individually evaluated loans are setting a reserve. And this would be good for if you bought a pool of loans where you might not have any loss history. You don't want to move that forward in the CECL model with a zero or approximately zero CECL amount. You might want to set 1% or whatever for that particular pool. You don't have loss history, but you know you could have losses in the future. So that would be another great example of individually evaluated loans. And the third example here, also lesser used than the troubled debt, is a partially guaranteed loan. And not to get too much into the weeds on this one, but basically, if you have a partially guaranteed loan, you might want to remove that from the overall CECL loan balance. You've got a guarantee on some of those funds. You don't want your CECL factor looking at your entire loan balance. You want it looking at your loan balance minus those partially guaranteed loans. So you can definitely get in touch with us if you have that situation. I'll be more than willing to walk you through it. Any other comments on IELs, Heather, before we move on?
Yeah, Troy, this is such a fantastic section, and I really think it is very important to be able to control some of those activities. And I do like the idea of being able to isolate some of these items and be ensuring that we're not skewing the rest of the pool based off of these individual activities. So like Troy mentioned, later in this webinar, we're going to be touching on our MFA Navigator, kind of showing you how you can enter some of these values. So I know another major part of this is our CCAs. I
Mhm.
know this is probably the most important part in regards to planning for the future on an individual basis on exactly how that pool activity looks. So why don't you tell us a little bit about some of the options that we have here, or some of the things we may want to look at to consider if we do need to implement some of these values?
Absolutely. Thank you, Heather. Yes, this is probably the most important adjustment that you can make along with individually evaluated loans. I work with financials on setting CCAs all the time. Very, very familiar with this concept. It's a very important concept when it comes to the overall CECL regulation. And the reason is, so the base CECL math is, like I said before, it's your loss history, your average losses, run through the model, gives you a CECL number. That doesn't always tell the entire story. And I'll talk to you a little bit more about that as we go through these. But as a general blanket concept, current condition adjustments are the way to sort of customize your particular CECL report to your financial situation, your delinquency situation, perhaps. So let's do a quick example. So let's say you have X amount of losses over the last few years, but your delinquency has been massively increasing in 2023, for example. You know that that CECL math is probably going to be a little bit light. You know your delinquency situation. The CECL model does not know your delinquency situation. This is where you would put in a potential adjustment in whatever those loan categories that are struggling with higher delinquency to bring up that CECL number, kind of make the examiners happy, have a little more cushion in there, show them that you are looking at these different things that are specific to your shop rather than just running the general CECL model. Non-accrual, same concept as delinquencies. We won't go over that. Warm, I won't go over this in much detail because I could talk about this one for a long time, but it's not utilized very often, but it is out there if you want to use it. So I'll spend 30 seconds on this. Basically, a warm current condition adjustment is available if you want to smooth out your CECL number based on the prepayment speeds you are seeing. Now, let me break that down a little bit. So, for example, prepayment speeds, when they are massively slowing, your CECL amount in that category will be higher, all other things being equal. Because you are getting less prepayments, you have a higher loan balance each of the years. Let's take mortgage, for example. Each of the years, you'll have a slightly higher loan balance. You don't necessarily have extra risk. So this warm adjustment is most commonly used as a small negative current condition adjustment to offset that additional CECL amount that occurred because the prepayment speeds were slower. The most common one I see of these four is regional and specific conditions. And let me explain a little about this one, as the title is very vague, but it's supposed to be vague. This is the catch-all current condition adjustment. This is the current condition adjustment that I use probably 90% of the time with financials as we were moving into live date. And here's why. So what this is it was often our way of creating a situation where our CECL number was above our allowance number at live date by a reasonable amount, 20, 30, 40, 50%. So let me give you a quick example. Let's say you had 2018, you had 5 times higher losses than any other year. Your CECL number would look at 2018, 19, and going forward would show an incredibly high CECL number versus your allowance. Your allowance wouldn't have looked back that far. So a lot of times when I was doing these meetings about a year ago, we would see that your CECL number was twice as high or 2.5 times as high as your allowance. But perhaps that 2018 was an aberration. Maybe that you had a rogue lender just giving out loans like candy. That lender is long gone. You don't want to necessarily use that 2018 as a representative year. You still have to put it in the CECL math. It's one of your official years, but you can adjust your overall CECL number down with a negative current condition adjustment in whatever category that might have been, which brings your CECL number down to a much more reasonable level. And that concept still applies today. Thank you for reminding me of this the other day, Heather. That concept still applies today. What if we had a situation where in 2021, we had a rogue lender or whatever. We can adjust those still today. This is not just a concept as we move into live date. This regional and specific condition, current condition adjustment is still valid for different kind of unusual circumstances. Like I said, it's the catch-all. Anything else you want to add there, Heather?
No, I think this is a fantastic kind of view and discussion because there are so many unique situations that can occur that maybe isn't expected to repeat over time. And as Troy has mentioned, you could utilize all of these moving pieces to kind of isolate those items and be able to capture some of these things. And as we get into showing you the navigator, it's going to kind of simulate examples of what this could look like and how we can work around that. So it's definitely a fantastic way of making sure that we are as accurate as we can be for those future expectations.
Excellent. Next slide. Perfect. All right. We won't get too much into the weeds on this, but it is an important concept to talk at least briefly about. So, and I've worked with a lot of you already on kind of understanding how the accounting works on this, but to make a long story short, you just need to bring your general ledger to the McQueen CECL reserve amount that you see on our report every month end. For example, let's say your general ledger is 2.6 million as of 9/29 or 9/30. You get the CECL report from McQueen on 10/3. It says, hey, you need to go to 2785039. All you would do is make the entry as the difference between what your general ledger shows and the CECL reserve amount on the McQueen report. This is an interesting example, and I don't want to get too much into the weeds on this, but just remember that it's not necessarily this $118,000 you see, because you may have entries in your general ledger that bring your CECL from that 2903 to some other number. So the important concept to remember is just bring yourself to the new CECL reserve amount. And whether that be monthly or quarterly, most credit unions and banks that I've talked to do the entry monthly. A few do it quarterly. So that quarterly report would be even more important to you. And that would be the one you would look at. You would ignore the middle 2 months if you're just doing a quarterly entry. Anything you want to add here, Heather?
No, I think you did a great job covering the importance of, entering in these adjustments, whether you choose that monthly or quarterly pace, but just making sure we're capturing that activity.
Very good. Back to you.
All right. So as we get into the next step of CECL, as Troy has walked us through all the steps that occur from our perspective, we're taking historical activity, we're taking expected future activity, and then the last piece of the importance of CECL, and one of the largest differences between this and our provision calculation, is incorporating the future market factors. And the reason why we want to incorporate this is because one of the biggest changes is setting aside a reserve for the life of the loan. So, what is this going to look like in the future? So, one of the activities that we do here at McQueen, and many different vendors use different approaches here, and that does vary from one to the next. But just an example of what our approach is or thought process is starting with the actual historical activity of where losses are right now. And as you can see, the average charge-off ratio from 2020 to current is only 39 basis points. This is significantly lower than what we had seen historically as a standard, probably closer to 1%. And a lot of this is due to those losses that never were realized during the pandemic due to the amount of stimulus going into the market. A lot of that cash was used to pay down debt. Now, we did experience very, very low or maybe no losses for a few years. So looking at that activity, we're starting with this historical trend. Now, again, this is the market factors that we're taking into consideration. We could utilize a lot of other pieces, such as our CCAs and IELs, to account for other moving parts. But the purpose of this exercise from the market standpoint is stating that we know currently our activity is showing 0.394% as our charge-off activity. So now, where do we expect these losses to go in the future as we go to the end of that life of those loans? So what we had utilized is using the market to show us what is our expected future unemployment rate. And that being around a 4% is what the market is currently showing as that forward projection. So if our unemployment level is at 4%, what is that expected charge-off percent to go hand in hand with that environment? And what this is showing is that environment expectation is 0.482%. So about 48 basis points. So if we're currently at about 39 and we have to go to 48, what is that spread or that gap between those two items? So this is showing about just over 8 basis points, meaning that we need to incorporate this and bump up those expected reserves for the future to reach the level that they are expecting by the end of the life of those loans. So that is one of the first steps that we do to incorporate this. Now, when we look at the market and we look at those historical losses, that may not necessarily reflect exactly what we're seeing. And some of this has a bit of a lag when you're looking at the big banks and the big activity that's happening. As we get into more of our world or our market, we're not seeing that activity at the pace that we may see a, Comerica Bank go through. So as that's happening, what we want to make sure is there any qualitative adjustment to kind of level set some of that activity, knowing there's a bit of a lag? And what we're seeing historically is about 4 basis points, a little bit of lag. We're going to bump this up just a hair, but we're going to make sure that this keeps us at a good pace so that we can be prepared for what those expected future losses are going to be, which brings us to about just over 12 basis points. So this is our approach to be able to account for market factors for the future. So this is that additional part that's added to our historical losses, any CCAs and IELs, and then we're incorporating this forecast adjustment to account for that gap between our historical trend and what the future expectations look like.
Heather, a couple quick things before you leave this slide.
Sure.
So just a reminder to everyone that we do update these numbers quarterly. So this forecast adjustment will potentially change and basically has changed every quarter, at least slightly. Second thing is this is the same number for all credit unions. Banks have a slightly different mathematical formula. We don't need to get into that right now, but for all credit unions, this forecast adjustment is the same. It's not looking at your particular institution. This is an overall national concept. And then the last thing that I want to at least briefly mention is I really, really like this forecast adjustment. And the reason I like it is because it's very examiner friendly. And let me explain that. So basically, if you have a lot of categories of loans that have zero or almost zero historical losses, this forecast adjustment will put in a small CECL amount, even if you've never had a loss on a mortgage loan, for example. Examiners will appreciate that versus seeing a zero going forward, because the concept of CECL is so forward looking that they would love to see at least a small projected CECL reserve in each category, and the forecast adjustment achieves that. Thank you, Heather.
Thank you, Troy. I thank you very much for bringing that up. It's very important and it's very true. And you do trigger that additional thought of this is updated on a quarterly basis. And one of the trends that we've been seeing all year is this number for the forecast adjustment continues to get smaller. And the reason why it's getting smaller is that gap between actual losses and those future expectations. Our actual losses are picking up and closing that gap. So this ongoing forecast has been narrowing over time as we actually are starting to realize a lot of those loss activities, really going back to a more normalized level in comparison to where we were during the pandemic. So we've talked a lot about all the moving parts that go into this calculation. So one of the things we want to take a quick look at, and I'm just going to switch screens here real quick, and we're going to go in and we're going to take a look at the MFA Navigator, which actually shows some of the ways that we can incorporate this. We have just a mock example, which is our Charlie Credit Union for Charlie McQueen here, and just an example of some of the things that we've talked about thus far. So the very first section of this is actually looking at the um, our activity from a projected life loss and then going into our calculations of our values, the forecast adjustment that's listed here, and our ability to be able to go in and make any adjustments from a CCA standpoint. The nice part is we've structured this in a manner where you can choose either a percent and put in basis points entry or a set dollar amount. So say that you want to set aside $1 million, you can go in and type in $1 million, and this is going to capture all of those moving parts. So this is looking at that activity. And as Troy had mentioned, we may have had a rogue lender in the past that caused a higher loss ratio, or you see here, we can put in some adjustments to level set and bring some of that down. So you want to use the tools that you have, whatever platform you're using, whatever approach you're using, use the tools that you're given to be able to control some of these pieces based off of the expected activities. So our first section is going into all the CCAs and our 4 different options for approaches and making sure from an examiner standpoint, we're kind of notating the rationale behind why we're doing some of these entries. As Troy had mentioned, about 90% of those are utilizing our regional and specific conditions. We want to notate the rationale behind that. The other 3 have a pretty straightforward approach, but we really want to be able to utilize those tools and explain why we've done those entries. Now, the second piece that was brought up was talking about our individually evaluated loans. And again, we can come down here, we can state that out of that $100 million of our mortgages up to 15 years, we did have a set loan that we expect that isn't going to pay. So instead of allowing that one item to skew some of those calculations because it hasn't been a realized loss yet, it's coming. So that our projected life loss isn't quite capturing this yet, but we know it's coming. So we're going to actually set that money aside, knowing that we are going to have to write that off. We could utilize that section to capture that. But you can use this for many different ways. It's definitely a powerful tool, very simple. We're coming in, doing a few adjustments. If you are using the McQueen model, instead of having to kind of reinvent the wheel every month or every quarter, this is saved and it just repopulates, leaving it for you to just have to review and ensure that we're still comfortable with the entries we have here, and everything will continue to carry forward as you enter those values. And then giving us our ending point here so we can watch some of those trends and make sure that we understand where those changes are and how we need to enter those through our financials.
Heather, real quick, and I don't know if everyone on the call noticed this, but the numbers that you adjust will change your number in real time. It's absolutely a wonderful application. You can toy with the numbers and you'll see immediately, oh, okay, my CCAs are now increased by the amount that Heather's typing. So you can do whatever you want with this. A lot of times I'll work with financials and we'll just really toy with the numbers. We'll say, hey, how does 1% look here? What's it going to do? Boom, in real time, we'll see a new CECL number.
Yep. Great point, Troy. We want to make this as interactive as possible and be able to help this make our decisions. And that's always a powerful thing to do right on the spot. Right. So going back to the webinar itself, we do want to talk a little bit about some of the volatility that we're seeing in the market. And one of the items that's causing some of that activity is month over month or quarter over quarter swings. We are seeing, as we talked about in regards to the market itself, there is a lot of activity that's kind of swinging and changing things over time. So really monitoring and watching what's causing some of those market factors to actually make those changes and that impact to our reserve, because that can can be material. So we want to understand if things are changing at a significant pace, what is the drivers of that? One of the activities that we did going from December of 22 to January of 23, as CECL went live, was identifying our loss history calculations. And similar from a credit union standpoint, when you look at a number or a ratio such as return on assets, from a bank perspective, that calculation is a rolling 12 months. So it's pretty consistent and pretty level set. But from a credit union standpoint, when we do that calculation, we're using year to date net income and then annualizing that value. Well, that can cause some volatility of that ROA calculation. We saw a similar activity in regards to some of our loss calculations. And that happened as we did that churn over of the year and using that annualized year to date. So, one of the adjustments that we made in our approach was using a 5-year look back period of our historical loss trend plus the current year. And as we did this, if you were only in first quarter, we looked at it as 63 months of losses and then did that calculation. That actually helped kind of level set some of those fluctuations that can happen when you're going in and annualizing a value that's a short term or a short look at that activity that's happening. So, however that approach is, whatever model you're using, these are the questions you want to ask if you're seeing a large movement and change over time. We know losses are really starting to pick up, things are starting to change. That's fine and that's explainable as long as we understand what those drivers are. So, the kind of takeaway of this is just making sure that we're asking questions and we're understanding what's causing some of those movements, because some of that may be a driver to reevaluate our current condition adjustments or maybe even our IELs that's caused some of those swings. So definitely a piece to monitor and watch over time and just making sure we're understanding what's driving those changes. Now, another large piece that does cause large changes to the reserve is activities such as mergers or transactions. There's a lot of those activities going on in the market. And so, Charlie, I'm going to hand it off to you to kind of explain what that implementation is to the balance sheet and how those entries actually occur.
Yeah, thank you, Heather. It's a lot of changes that have happened here, a lot of uncertainty. And so just to clear up a couple things, historically, when we were doing a merger or an acquisition, what we end up doing is creating a loan contra account, which is the life of the loan losses. And then that would be amortized into income over the life of the loans. So in theory, every month that you have a loan loss, it matches the exact amount that's coming out of this reserve. That worked really well and it worked fine and went well. And then any new loan would go into the ALLL calculation. Now, we expected that this is how we'd roll into the CECL world. Now, unfortunately here, as we go to the next slide, we're seeing that the historical process isn't what's happening. Now, this is under FASB review. There is a comment period that's ongoing, and we do expect to change this ruling in the first quarter of 2024. But what happens today is CECL's actually removed from transactions where it's not even involved. There's no loan loss, there's no CECL loss at all. And then on day 2, the dollars are put into your CECL account. So for example, if you're doing a merger and the credit union has $1 million CECL account, that gets backed out, you do the merger, and then on day 1 or day 2, you have $1 million expense. The net of everything is the same, but instead of having it go from a CECL to a CECL, it goes from CECL to an expense. So it's a very frustrating spot right now. Now, this is not how all accounting firms see it. It's really important if you are doing a merger to talk to your accounting firm or an acquisition and make sure you're prepared for it. So we go to the next page here, we'll see that there are some people doing things a little bit differently. Some accounting firms have really different opinions here, and they're having you do both a loan contra account and a CECL reserve, and you're effectively double counting for losses now. So we're seeing all sorts of different things out here. So the point is, what we don't think the double counting is correct. We don't like the way the previous one is mentioned, where it's an expense on day 2. We believe that's the correct interpretation today. But most importantly here, talk to your accounting firm if you're in the midst of any sort of combination merger acquisition. And then again, we do expect FASB will be changing this rule somewhere in the first quarter of 2024 as the accounting period is open. So a lot of things changing here. Just wanted to give everyone a heads up on that. And if you do have any questions, please reach out to your advisor and they can talk to you about this. Thank you, Heather.
Thank you, Charlie. This is definitely a very important part as we are definitely seeing more and more activity in these areas. So just making sure we're prepared and know how to implement that.
And Heather, I do want to add one thing. I think you did a great job just a moment ago before I hopped on talking about big swings. If you do see a big swing in your CECL, have a call. There shouldn't be a surprise to anyone. If you're not working with us, you have your own CECL model, you see a big swing, call us. That's not how it should happen. We hear about black box models all the time. It's not how it should be. This stuff is should be very auditable, and we should be able to understand any change that's made. So you and Troy Heather do an incredible job, and you guys make it really simple and clear to everyone. So thank you very much.
Thank you. We appreciate everybody partnering with us with that, those that have. And like Charlie said, we want to make sure that we understand these swings and changes. And volatility is definitely a big concern right now. So let's continue to monitor those. Now, one of the things that we have found is the transition of going from leading up to the start of CECL and CECL actually being live. We spent a lot of time working with institutions across the country to get ready for CECL. And as we moved into that, and then once we went live, this is right in the start of a little bit of kind of pressure in the industry and some changes that have happened. So our market looks very different now than it did leading up to CECL going live. And I know, Troy, you and I spent a lot of time working with institutions all over the country on different obstacles and things that they have to deal with. I know we've got a few examples of some of those conversations that we have going on. Give us a little bit of an example of some of the common ones that we tend to work through.
Absolutely. Thank you, Heather. So I kind of already went over one of the most common ones earlier when we were talking about current condition adjustments, really dealing with big potential CECL transition amounts, unrealistically large, and you can set some current condition adjustments. These here on this page are more the kind of phone calls and meetings that I have nowadays, now that we're past the CECL transition amount. And I'm actually going to combine financial A and financial C since they're very similar. So basically, these two financials called me up and said, hey, I know we had current condition adjustments set from when we went live. Are these still appropriate? So we would work together and say, okay, well, maybe they're not as appropriate. Your CECL number seems to be a little lower than it needs to be. Let's set some current condition adjustments in the area of delinquency, perhaps, like I mentioned earlier. So a lot of financials are concerned that because of the potential recessionary situation that we are dealing with potentially very soon, depending on who you ask, that maybe their CECL number has gotten a little lower than it needs to be. Back in the day when allowance was a thing, I know a lot of financials liked keeping a cushion in that allowance for loan loss account. People are kind of wanting to do that right now for those same exact reasons, a little bit of economic protection. So what the conversation I've been having a lot is just like I said, we're just going to set some current condition adjustments, buff up your CECL amount a little bit, give you a little buffer. But the key to this is document, document, document. You really need to document whenever you are changing or setting up a current condition adjustment, whether it just be with a simple spreadsheet showing some delinquency trends or charge-off trends, just something to show that you're really looking at these and understanding the amounts of the current condition adjustments that you're putting in. And financial B is kind of a different situation. And it kind of alludes back to what I was talking about a little bit ago. And let me dig a little further into that regarding the individually evaluated loans. So earlier when we did the example of the auto loan, the $50,000 auto loan with a 60% chance of going bad, the disadvantage of setting that up, if you called me up today as one of our credit unions or banks and said, hey, Troy, I really need to set up some individually evaluated loans here. Like I briefly mentioned earlier, that would be a hit. Your CECL number is going to increase that month end when you do that particular entry at the time you go to these individually evaluated loans. But here's the advantage. Then look down 2 months. Let's say this car loan charges off for 30,000 of the balance 2 months from now. You have already set up that individually evaluated loan. You have already bumped up your CECL amount by that $30,000. When the charge off hits, you'll simply remove the individually evaluated loan from your CECL calculation, and you'll have a wash in your general ledger when you charge that loan off. So it's basically a expense it now versus expense it later. And credit unions and banks sometimes as well do want to be a little more conservative. If they know that this auto loan is going to go bad potentially, why not reserve for it with an individually evaluated loan now? Then you don't have to deal with those swings later in your general ledger when you charge those items off. That's it for that slide, unless you have anything else, Heather.
No, it definitely gives us some really great examples of some of the things that we want to be prepared for. So, just to kind of recap all of these steps, because I know we went through a lot today, but these are all important when we approach CECL, especially in this live environment. So, we want to be sure that we are capturing our capital adjustments with CECL as we go into that year two. And this is starting for many institutions as we come into the end of fourth quarter. So, just making sure that we understand that. I know the NCUA has stated that we can do our write down over that 12 quarter time period. From a standpoint each year, we are doing that for credit unions would be a third, and then a third in year two, and then the final portion in year three. So over that 36-month time period. So just be prepared, knowing once this starts that we may have some impacts to our net worth or capital position as we go from one quarter to the next. And some of those swings are going to be by that implementation of those values. So making sure that we're deciding on timing of entries. Another question that came in was stating that we close our books on the 10th of each month, but CECL, we have to use a month lag or delay in preparing calculations because third-party indirect participation loans. Is this acceptable? This is acceptable, and this can be on a month lag if we're comfortable with that. But you do have an opportunity here as well, is to use preliminary values for those pools. If there's no activity of loans completely paying off or new loans going on the books, and that monthly transition is simply maybe some small payments, an immaterial amount, we're okay using preliminaries to at least identify what those values are. So you do have some flexibility between those two things. So it just depends on what we're most comfortable with. But again, that consistency over time. Now, being sure that all of our historical losses have been captured, making sure our starting point of those loss ratios are accurate, utilizing our IELs. Another question that came in regards to IELs was we used to be limited to TDRs and loans which had a loss, where a loss had been deemed probable. This is no longer the case. Well, historically, TDRs was kind of that focus point and the activity of what this was used for. What we have found in a little bit of feedback we're starting to get from examiners as CECL examinations or audits are starting to happen for the first time. We have worked with examiners and audit firms, or I'm sorry, accounting firms to see, do we have flexibility here? And so far, the response is yes. We can utilize that section to use this for different approaches to be able to isolate. Like we talked earlier, you may have partially guaranteed products. We can utilize that section to isolate those amounts out. We have more flexibility now than we did before. CECL's approach is kind of taking the seat for some of those TDR approaches we may have used in the past. So we definitely have some more flexibility here. So utilizing those tools the best we can, including those CCAs as well. And then again, understanding the market impact that we're seeing with our forecast adjustment. Like we've been talking, that volatility has been a little bit heavier recently than what we've seen in the past, and making sure we're understanding what's causing those shifts and those adjustments. And then again, if you have any questions, any concerns, not sure how to approach this, reach out to your advisor. We're here to help you through this process. You are not in this alone, and we're not wanting to make a shot in the dark either. We want to use these tools. We want to work together to identify what is the appropriate value that we want to be able to be capturing here. And this is really the most important portion of that. Any last thoughts on CECL in this live environment?
Great stuff, guys. I appreciate it.
All right. Well, we want to thank everybody. And I think we have answered the questions that have come in so far. So again, thank you for joining us today. We really appreciate the partnership and joining us in this discussion. Charlie, Troy, and myself are all available for any point of which you need. Again, we appreciate everything. And we also want to let you know that we have another webinar coming. This one is going to be our economic update as we're coming into year end. And especially into this budgeting season. So on November 9th, we are going to have that MFA economic update. So please be sure to join us. And after this is completed today, we will have a recording saved on our YouTube channel that will be available through our YouTube channel. Or if you go on to our website, there is always a link to that video as well. So thank you again for joining us today. We look forward to talking to you soon, and we will see you on the flip side.